Go ahead, Ken.
Good evening, everybody. This is Ken Cavullo from the Mid-Michigan chapter of Better Investing. I'm joined with my good buddy, Mark Robertson, who's a director on our chapter, but also the CEO and president of Manifest Investing. And we've been co-sponsoring these roundtable programs now for, Mark, is it 13 or 14 years now? It's been a long, long time,
Well,
I know.
right in between, 13 and a half. We're actually within 5 or 6 months of completing our 14th year.
Okay, it's been a long time. We're joined by our friends Matt Spielman from the Houston chapter and Kevin Galagli from the Maryland chapter, and we hope to have Hugh McManus from the, I think it's called the Golden West chapter now, that he belongs to out there in sunny Southern California, and we'll see if he can make it tonight to be with us. Let's go through the disclaimer real quickly if we can, Mark. We're not the boss of you. That's what we can put this disclaimer down to, just that real simple sentence. We don't expect you to act on anything that we say tonight, except maybe to take an idea that we give you and study it and then make your own decision about whether it's suitable for adding to your portfolio or removing from your portfolio, or just thinking about as you listen to the presentations. We'll try to tell you when we own any of the stocks we're talking about, but we don't always get that chance to do that. So please be aware that, again, everything we're talking about tonight is for illustrative purposes only. It's an educational program, and we don't want you to buy, sell, or hold unless you do your own homework. If you'd like to be added to our roundtable reminder list, then you can drop an email to ncavula1, that's my wife, at comcast.net. And Natalie will make sure that you get instructions for how to add yourself to our guest list. The procedures have changed a little bit with Better Investing, and you actually have to add yourself to our guest list, but it's a real simple process, and she will send you simple 1, 2, 3 instructions on exactly how to do that. Oh, excuse me.
Bless you.
We're happy to add anybody to that list. Just have them drop an email to Natalie and she'll make sure they get those instructions. If you'd like slides of tonight's presentation, send an email to Mark R. at manifestinvesting.com. That's the fastest way to get the slides. If you have questions or comments, feel free to email either one of us, and our email addresses are at the bottom of the slide that you're looking at right now. Next slide, Mark.
Oh, no.
Oh, no.
I seem to have lost control.
Try your forward key.
I did.
All righty. Let me
see if I can just jump out. I don't know if I can jump out. That's what I get for tinkering.
All right, hold on just a second and I will get up.
Just proves to you once again we trust those people that graduated from University of Illinois. They've got to be either blue and gold, or they have to be
all right, I got it back.
Yellow.
Do you have it back? Okay, because I just got the backup up. Okay. Yes, here's our performance, folks. It starts when we were 3 years old. The graph is getting so wide that we can't put all of our years of existence on it anymore. And that orange dotted line is our goal. We'd like to beat the market by 5 points, and we measure the market by the Wilshire 5000. That's a really broad index of 5,000 commonly traded stocks. We're beating the market right now as of the end of trading today by 4.7%. So we're 0.3% beneath what our goal is at the moment. The total rate of return for this portfolio is 15.9% annualized. That's a pretty hefty rate of return. The Wilshire 5000 during that same time period, making the same withdrawals and additions, is doing 11.2%. Subtract the two numbers, and that's where that 4.7% comes from. Like Mark said, and like I said earlier, we're moving up to our 14th anniversary. I think it happens in June or July. We'll have a big celebration at that point. One of our other goals is to have an outperformance of at least 50%. We'd love to have an accuracy of 55%, which means that we'd like at least half or more of our stocks to actually be beating the place that we bought them at, outperforming the total stock market index. Right now, what is our performance accuracy? Yeah, it went over 50, Mark. That's great.
Yeah, just
It's
up over 50.
50.5. And what's that 54.7 for, Mark?
That's what it was for the last year, and then I think, and we're going to look at the next slide and see we did pretty well.
I'm going to let you take the next slide then, Mark. Go on.
Yeah, just a couple of things for reference. This actually represents the average return, again, minus 3%, 3 percentage points relative to the market for the average equity mutual fund. And that's just to give a little bit of context. And again, our golden rule, golden line, is to try to beat the market by 5. So that's what's there. Here's a look at the last year and the performance of a few things, including a few individual stocks. But you can see that the Investing Roundtable actually did generate a pretty good return for the last year and really stabilized our results over the last 13 and a half years. And pretty good year for the market in general, with the Wilshire checking in at 26. So we're just grateful. And as the point that we've made several times, many of these companies up at the top are nestled in our own personal portfolios. So
yeah, let's make it clear as we look at this chart all the time that if you're looking at that last column and thinking that's the return, that's not. That's the relative return. That's the percentage that whatever you're looking at beat the market. The annualized return is one column in, and those numbers are extremely impressive. Look at that Amazon return for the last year. Those of you that held Amazon should be really happy people at this point. In fact, holders of any of those top 4 stocks should be pretty pleased at the yearly return to this point. I'm really, really thinking to myself that the small caps and the mid caps have begun to recover, Mark. What do you think?
They definitely have. It's in different ways of looking at it over longer terms. Most of you guys are used to seeing longer time horizons for this chart, and both of these have begun moving up. And the advances in the small cap area in the last 2 months are huge. All right.
I think we actually saw total return numbers for those two indexes. They're negative for a large part of the year before they began to turn positive, maybe in mid to late October.
Absolutely. Here's a sampler of some of the best stocks chosen over the last year in terms of their return performance. And I love that first one. I do, because it's a perfect example of the, you present a company like that, Ken, and some of us yawned a little bit and said, yeah, right. And it's kind of boring. And there's nothing boring about this over here.
That's the one, Mark, that if you go back and check the presentation, and you can actually go back and check the value line if you want to. I quoted value line as saying that you should own this stock. And I don't think I've ever seen value line quoted telling you that you just flat out, you should own this stock. So I put that into that Fabrinet presentation back in April. And boy, I just wish that I would have bought it myself. That's all.
Yeah, I mean, every once in a while, a stock like that seems a little bit routine or boring can certainly be very rewarding. And it is nice to see Kevin on this chart too.
I love you too. And
Well,
that was
Mark,
the one time that's the one time I got the audience to join me, and that's the night that I beat Ken, and everyone should have gone with Fabernet instead. They
There
were
you
on the
go.
same night.
There you go.
I do think that the audience is right more times than we'd like to admit, Mark. Look at the number of times the audience is on this short list.
They are.
They picked Adobe, they picked KLA, they picked Technoglass, they picked Globus Medical. Maybe they know more than we give them credit for knowing.
Could be. Well, tune in to the roundtable in February when we have our black tie red carpet affair. And right now, Ken, you can make some room on your trophy space just in case.
Well, I haven't gotten a trophy in a couple of years here, Mark, so I got lots of space reserved. Okay.
All right, let's move on to the companies that are specifically responsible for the long-term performance of the roundtable. You can see the top 20 by percent of total assets listed here. You can check them all out at the link on the right here. That's a public link, so if you enter that entire link, you'll see all the active holdings. And so this is listed from largest holdings to down to the number 20 position. The key up at the top, or the legend, is basically the number of times a stock is chosen. Every time a knight or a damsel or the audience selects a stock, we invest $1,000 into it. So Microsoft, we say this every month, has been chosen 5 times. 5,000 invested in Microsoft is now 95,000. So obviously we talk about that one because that's the A plus on this report card. And there's some pretty good performing positions on this particular list.
And I always get the question, Mark. People mail me the question that we left Costco off the legend, and folks, we did not leave Costco off the legend. Costco's only been chosen one time. I know it's in the top 20, but it's only been chosen one time. That $13,855 comes from a single choice. Hugh McManus made it. It must have been, I don't know, 10 or 11 years ago that he made that choice.
Very early. Yep.
Yeah, it would have been really nice to put $1,000 or maybe to put $10,000 into Costco at that point and see where it is today. It's a wonderful, wonderful investment, and there's no mistake that we know of in the legend. It was only chosen once.
That is correct. Okay, ready to move on? This is a slide that you have seen a number of times, and we think this is just one of our favorite GASP slides, and it really puts a lot of things into context. Over the last 13 and a half years, we've made 780 decisions, so that's at $1,000 each. The rate of return on those decisions is 16%. 220 of those selections have actually either permanently, because it's a closed position, or hopefully temporarily dropped down to an unrealized position less than $1,000. So again, roughly a quarter of the time, our original $1,000 is slightly in the red, or sometimes not slightly, and we learn from those moments too. But the cumulative loss for those 220 positions is $64,900, and then you just basically put that in this context. Microsoft all by itself has gone from 5,000 to basically 95,000. So you're talking about a $90,000 gain in Microsoft alone. That offsets the losses from all 220 positions and then some. And I just think this is a staggering reality. And every time I see it, I think, what in the world are we ever afraid of as investors?
And I think, Mark, that when we use this slide in our just beginning classes that are going to be held tomorrow and Thursday, I think that the point we're trying to make, not only with the beginners, but with every single investor, is why not pay more attention to the stocks that are doing well and a little bit less attention to the losses that you have. If you manage the portfolio paying attention to your winners, And if you manage the portfolio judiciously, pruning out the few losers that you have, or even if you have a quarter of the portfolio that's losing over time, you end up with this kind of performance. And it didn't take 100 home runs to balance out the losses. It just doesn't take that much to make it happen.
Yeah, and you can even take it a step further, and maybe we will at some point. You could probably take the top 3 positions, and the gains from those top 3 probably would offset if all 220 of those had gone to zero. You know, you think about that sort of thing, that's just wild. So good, clean fun. It shows that investing with your friends can be a rather compelling opportunity.
Mark, on that point, I'd like to be able to say that's exactly the example that David Babson had in his book back in the 50s that became the rule of 5 that we talked about, that one winner can really, really take you a long, long way.
Absolutely. And you got to be ready to let them run. And we talk a lot about buy and hold for as long as it makes sense to do so. And you want to give them room to run for sure. Anything else, guys? Any thoughts come to mind?
We're getting a question about whether the beginners classes, the Just Beginning series, is going to end up on YouTube. And of course, we'll be having those series on YouTube, but they won't appear on our YouTube channel until after we've completed them. You still can register for those series. There's no limit as to the number of people that can register. If you go to the Mid-Michigan chapter part of the webpage, and the Better Investing site, you can register right there for the 3 classes. They are designed for people that are just beginning, hence the name of the series, Just Beginning. We don't want to missell this idea that this is a great thing for experienced people. You might pick up an idea here or an idea there, but the focus will be on novice investors, and we're going to start with real basic things. Those programs are going to be 2 of them tomorrow and 1 of them on Thursday. And I think the times are 6 o'clock and 8 o'clock Eastern time tomorrow and 8 o'clock on Thursday.
Yeah, and it should be a good time. I have also told people that if you're in a situation where you're trying to get a friend or a family member interested in the notion of owning companies and investing as we do, I think slides like this give you some ammunition to do that. So can nudge and encourage some ideas to propagate from it also. Okay.
We'd love to see 20-somethings and 30-somethings there, but we're going to be satisfied to see 50-somethings and 60-somethings there. Even at that point in your life, folks, it's not too early or it's not too late to start investing.
Absolutely. All right. All of our housekeeping done, Ken?
I think so.
Well, let's turn Kevin loose.
Very good.
That's always a scary thing to hear, Mark, okay?
What are you talking about? I love it. I'm stretching my arms right now.
Okay, great. Take it away,
My name's Kevin
Kevin.
Galogly, and for clarification, I am in the DC chapter, not in the Maryland chapter. I live in Maryland, but I'm in the DC regional chapter. And I'm glad to be here with folks that like to be able to talk about investing. And tonight I'm going to be able to talk to you about Chevron Corporation. So let's go to our next slide. All right. And this page is sponsored by the Molly Maguires. We are in the Groundhog Challenge. And just to let you know, we're in the bottom half of the bottom half. We are not doing too well. We are probably right about the Mendoza line. And that is my nephew. And he was taking me to the airport at 4 o'clock in the morning. And I was able to bribe him with donuts and coffee. You know, we found a 24-hour donut place. But anyway, so we are sort of in the dogs of the Dow of the Groundhog Challenge. And what I wanted to do was look at the dogs of the Dow as it's talked about in investing circles. The term of it comes from Michael O'Higgins' book from 1991. And the whole idea is that you would look at high quality stocks that are beaten down. And generally they suggest rebalancing your portfolio once a year, usually on January 1 or January 2. And the way to do it is to be able to get the highest yielding stocks. So let's go to the next slide. And I just want to go over some basics. I know I was looking through the audience and we have a lot of experienced people, but if this is up on YouTube and people don't understand it, I want to go through some of this. So what we're looking at is the dividend yield. And again, so the dividend yield, I've used the example of $2 in dividends or 50 cents a quarter. And if the stock price is $50, that means your yield, and you'll see this in the bold there, of 4%. And the way you get that is if it goes 0.4 times 100. And just to let you know, percent is Latin for per 100. And so that's how we do it. It's the same root word for cents, for century, and for centurions, which were 100 soldiers. But therefore, you have 4%. And companies don't pay out dividends unless they have enough cash to pay for it. Generally, there are companies that don't do that, but I mean, for the most part, it is. So this becomes a proxy for sort of the financial health of a company. And you can look very quickly. This is the latest value line summary from the 29th. And if you can mark over there, mark where the estimated yield is at 2.2%. That's a medium, so it's between there's 50 above and 50 below. And that sort of gives you kind of a benchmark on where things are. So when you take a look at it, when the price goes down, the yield will go up. So you'll see a market high there of 3.7, and then the market when the market goes low, the yield will go up. So you'll see that's where it's 3.7, and in inverse, when the price goes up, the yield will drop. So that gives you sort of a range to take a look at things. So let's go to our next slide. And so I just sort of explained it here. Here's a working out of this. So if that same example, instead of being a $50 stock price, it becomes 40, the yield goes up to $5. So therefore, it means a declining stock price will give you a greater yield. That gets back to dog of the Dow. If you want to understand more, there's a hyperlink on this. So if you get the slides from Mark, or I can give them to you too, you can be able to look at some more of this. Let's go to our next slide. So the next thing to talk about when we're doing dividends is to talk about the payout ratio. And that's different because here we're talking about the annual dividends to the amount of earnings. So if you had $2 in dividends, and you ended up having $4 in earnings, your payout ratio for the year would be 50%. And so we can use that as sort of an indication of where we are in sort of the whole scheme of things. And if you want to learn more, again, there's another hyperlink for you. Let's go to our next slide. So we have in the SSG, you can be able to see both of those things very, very quickly in column G and in column H. So again, H is a high yield, so that means when the price is the lowest, and we measure those things there. And as you can see, these are my judgments on Chevron. I took out those years where there was no earnings because there's no meaningful number, and one where the payout ratio was exorbitantly high. The thing is that if you look at column F, that's how many dividends per share every year. And as you can see, those numbers are going up from 2018, where it's 448, down to where it's current or trailing 12 month at 604. And so Chevron has had 36 years of continuous dividend. You may hear people in the market talking about dividend aristocrats. Those are ones that have 25 years of continuous dividend growth, and there's 68 of them. And then there's dividend kings. Those have been having continuous dividend growth for 50 years, and there's 54 of them. So you can see Chevron is somewhere between an aristocrat and a king. Next slide. So what I also did is I looked at the Dow Jones 30 and said, which were those, how do they look on the ticker heat map? And just to let you know, this page is sponsored by the hot dog runners at the Columbus Clippers. And I'm too bad that Cy isn't here, because as a huge baseball fan, he would be telling you how wonderful it is to be able to eat hot dogs, baseball, apple pie, and your Chevrolet, all while watching the Braves win. Anyway, but what I did is I looked at this, and there's 20 of the stocks from the Dow Jones 30 that are on the heat map. And what I also did is I looked through all 30 and said, let me look at section 2 of the SSG and see which ones have all three green. You know, when you look down in the lower right-hand side, and you'll be able to see the color on whether the trend is in the correct one. When they're all green, it means your management is really, really well. and for at least for that last year. And you see there are 6 of them, and I've highlighted them in sort of that sort of pinkish red. And they all, they're sort of across a wide range of the market. But those are the ones that intrigued me the most, even if they're not necessarily the dogs of the Dow. So just to use this as sort of a shopping list. Let's go to our next slide. So what I also did, and I put this up as a public dashboard up on Manifest, is I put up all the Dow Jones 30. And again, remember the premise of the dogs of the Dow is you're looking for the highest yield. Now you can do this at any time of the year. You don't have to do it on January 2nd. But what you can do is that with this is that just sort of go where I have that blue arrow with the projected yield, sort it on the highest yield, and you'll be able to see those are the ones that maybe you ought to be purchasing right now. And if you see that, the one with the highest yield is IBM, and they go all the way down to the 10th one, which is JP Morgan. And all the ones that I had that had the really, really good section 2s on the SSG, I've starred over on the left-hand side there. So what I really did was Chevron. In fact, when I originally picked Chevron, it was in the top 10, but because of the way things sort of went in the market, it sort of dropped out of it. But you can see where it's sort of in there. Now, keep in mind, these are not necessarily going to be core holdings, and I consider a core holding something that you've had that you're going to own for 3 or more years. Long-term in investing circles means you're holding it for at least a year. I'm thinking you're still going to hold this for a year, but it may not necessarily be a core holding. And the thing is that you can see the growth rate on this portfolio averages. If you can mark that up there on the upper right-hand side, that's not a big growth number. These are, again, big established companies. 6% is really good for them, but it's not the kind of big growth companies that we're going to get. So I just sort of want to give you some caveats with this dogs of the Dow. Let's go to the next slide. And so let me tell you a little bit about Chevron. It came out of Standard Oil. They got separated, and then they were Standard Oil California, and then they were with Texaco. They're out of the San Francisco area, and they're one of the original 7 sisters. And again, with these slides, there's a hyperlink to that. Chevron produces 3.5 million barrels of oil and gas every day. And what it is to understand the industry is it's a vertically integrated oil and gas company. What does that mean? It means the oil and gas industry is divided into 3 streams: upstream, which is exploration and production; midstream, which is processing, storing, and transportation; and then downstream, which is refineries and marketing. Chevron does all 3, but what they really haven't done is they really haven't done as much in the midstream. They just made a purchase and they're in the process of closing on Hess Midstreams to be able to help them in that area. But the fact is that most of their money comes from the upstream. So I want you to keep that in mind as you're going through it. The amount of money that they get from that upstream allows them to pay $12 billion with a B in annual dividends, allows them to repurchase shares, which they do quite frequently. It allows them to pay down their debt and also allows them to fund their acquisitions. Between Hess and another one, they have put out $60 billion in acquisitions in this last year. And so this is a widely held company in the better investing community. Next slide. All right, now at this point, when Ken likes to be able to talk about up, straight, and parallel, you're going to say, Kevin, get your glasses corrected because this one stinks. All right. And what I'm going to tell you, as Sergeant Farrell told Tom Cruise in The Edge of Tomorrow, is that the good news is there's hope for you. And so if you look at this, the numbers, the lines on that looks like the polygraph of a liar. And if you look at the latest quarterly numbers, they're clearly negative. If you look at the analyst consensus estimates, they're both negative as well. So it's like, Kevin, what are you thinking? Well, if you look at the Manifest Core Score, it's 203. What's holding it back is the earnings predictability. Duh. Look at the earnings line. It's really, really bad. But also look at the financial health grade in the upper left. That's an A. That's in the top 9% of all stocks, U.S. stocks, in the feed from Better Investing. And what I've done here is that if you go into the legend over on the lower right-hand side there, I've highlighted the sales detailed estimates and the earnings. So I end up having those dots for years 24, 25, and 27. I've marked those there. And I want you to see that those numbers in 27 are just the numbers that come straight from Value Line. I'm using it not to make my own judgments, to use as a guidepost, just like you would if you're going down the steps to your basement and you use a handrail because the light's not on. I'm using it to guide myself. The second thing is, if you look at—
Kevin,
yes,
could I interrupt for just 1 second?
absolutely.
Are these dots that you placed on here just the dots that came on when you clicked those lines there?
24 and 25 are. 24 and 25 are the analyst consensus estimates.
Okay, I just wanted to save myself some emails. Folks, that data is coming from Morningstar, not Value Line.
But the one in 2027 is Value Line numbers. Does that make sense?
Did you put it in there?
Yes, I did. I manually put it in.
Great. Okay.
So I'm using Value Line in 2027 and the analyst consensus estimates that are already in the data for 24 and 25.
Great. Okay.
And so, as you can see, my judgments, and those are my judgments going through those dotted lines with the sort of baseball diamond at the far end, that's where I'm projecting for both of these to be. And so you may look at this and say, oh, Kevin, that's really, really off. But if you can see that, it's going to make, I think, some pretty clear sense on where I am. I'm really pretty much right along the same lines as Value Line, and you'll see that in my conclusion. Let's go to the next slide. And this slide is sponsored by Joey the Jaws Chestnut. He's the 16-time champion of the Nathan's hot dog eating contest in Coney Island on the 4th of July. And I want to let you know that we have our own hero in the better investing community that's going to take on Joey the Jaws Chestnut. In fact, if you come to Bink in Chicago in May, you'll be able to see him chomping down on a whole bunch of Portillo hot dogs. He's already won everything in the better investing community. Ken, the Komodo dragon Kavula, will be sitting there and showing you how to be able to eat hot dogs as well as Joey the Jaws. So come to Chicago and watch Ken Kavula eat those like a Komodo dragon. Now, getting back to this, Chevron is a commodity-based business. This is the price of oil, the West Texas Intermediate, WTI, over the last 10 years. Look at that price. You can see the price of the barrel over on the left-hand side. Now go back to the previous slide. Look at the earnings. Do you see the same dips in 2020 and 2016? It's the exact same thing. This happens with commodity businesses, okay? And so here's the thing is that it's a protection against inflation, because anything downstream from the oil and gas industry is going to, like if, let's say you need trucks to be able to move your products, or you need oil and gas to be able to run your machines. That's all sort of going to be baked into it. Here it is that the crude oil price at the end of 2023 was $74.16, and that the estimates are generally going to be somewhere in the mid 80s. I've seen it as high as 90 for the next year. And if you believe that's going to be there going forward, this would be a really good indicator of where things are going to be with this stock. So let's go to the next slide. And here's Morningstar. And again, one of the things I really look for is the red box there that's the capital allocation. It's exemplary. That's again in like the top 5% of all stocks that are covered there. So that means the management is able to use their capital allocation very wisely. We like that. If you look at the blue box over on the far left, the price / fair value estimate, anything that's less than 1 indicates it's undervalued. And you can see that with the graph. Anything in the blue throughout this entire time period is in blue. And that's the undervalued, and only the stuff that's in sort of that off orangish red, sort of, we call it Texas burnt orange, is overvalued. Now keep in mind, as we said with dogs in the Dow, this is one that's been beaten down. It was 16, Chevron is down 16% over the past year. Compare that to the Dow Jones 30, which is up 13%. So those are the things that are sort of going forward with this. Let's go to our next slide. So their growth strategy is pretty much that they still have the second largest share in the U.S. The International Energy Agency is estimating that all-time demand is going to continue into 2030. And if you look at the Motley Fool story and some of the stuff I've read on it, Chevron is sitting there and saying their capital expenditure will be somewhere between 19 and 22 billion per year, every year through 2027. The way they do that is because they generate so much free cash through the price of oil. And if the price of oil is $70 a barrel, and we're already seeing that it's at 74 and could be in the mid 80s, they're going to get 1 billion in free cash flow at $70 a barrel, and it'll be exponentially higher if it's in the mid 80s. And then if the price of oil is over $70 a barrel, they're going to repurchase shares, so they're going to resume doing that. So keep those things into the factor. Next slide. So the next thing we want to do, and this slide is sponsored by Mark Robertson and Manifest Investing. He's celebrating, it's the first time in 30 years that the Detroit Lions have won anything. They've won a title. He saved those hot dogs. They haven't been put in the refrigerator since they last won in 1993. And with all the fine preservatives that are in that hot dogs, they're ready and able for you. And so if you too come to BINC in Chicago, and you can be able to tell us before we're done with this presentation, who is a player that Mark is celebrating there, the jersey he's wearing, he will give you a free Portillo's hot dog if you come to BINC. So be prepared for that, Mark.
Awesome.
So, and you can't look it up on YouTube or on Wikipedia. You're going to have to come up with it yourself. But one of the things I like to do is I like to look at like the scuttlebutt that's out there, see what people say about the company. And Glassdoor and Indeed are two good places to look at it. Both of them are very favorable of Chevron. They like the place to work, good benefits, good working environment. So there's nothing that's indicating that this is really, really a bad company. So let's go to our final slide. And so here's my judgments. Like I said, the three greens in the management are in the upper right hand. You can see all my judgments over on the left-hand side and sort of the yellow background. And yes, my future earnings per share is 11% when the sales is only 4. And if you go back and look at these slides and see where I am, I'm pretty much along that same line of where I am. So it's not like that number's really, really off. It's because it's coming from a downspout. And here it is. The current PE is 11. I'm having a nice range between 9 and 15 for there. I get this as a buy. I think it's a buy up to $160. And if you compare that, it's a little bit higher than what you see at Manifest. My par is 15.8 on the SSG, and over on Manifest, it's 12.4. But overall, I think that this is a really good company. I think it's something you can hold for long term, at least a year. And it may not necessarily be a core holding, but there's a lot to like about this because it's beaten down and it's a dog of the Dow. That's my presentation.
Okay. Thank you, Kevin. Good stuff.
Enjoy your hot dogs.
I am enjoying. And now I got to stop at Portillo's on the way to the convention. Good stuff. All right, let's switch gears to a very, actually a community favorite now. It's been around enough that people have taken a liking to Green Brick Partners. Take us away, Matt.
How about that? Thanks, Mark. Next slide. So Ken approached us a week ago, Tuesday, which is a ton of time compared to normally guest nighting on the round table. But whenever, not having to go through a 2-minute drill, whenever I think about this, I start with a nice screen and just see what kind of comes to me. I've cheated a little bit on this. Trust me that last Tuesday, Green Brick Partners was 19.1%, but I happened to get this screenshot on over the weekend, actually, so for Friday's data, and it slipped over. So I'm simply looking at the sweet spot for par and a quality of 80, highest quality group. And there are a number of things I like on here, companies that I've either invested in or investigated, and I just couldn't ignore the fact that Green Brick was just on the top of the list, kind of begging to be talked about. And you might wonder, in fact, is a big part of my own personal performance in 2023. I do own Green Brick personally. The stock has doubled in the year. And I really wondered, would it be crazy to go and review a stock and propose that we invest either roundtable dollars or you might investigate to invest your own dollars in a builder at this point? And I can only say it's probably only about just as crazy as it was to do so last year at this time. Mm-hmm. When the Fed was about to begin raising rates, when we were sure to head for a recession in 2023, and things weren't going to work out. And that certainly didn't turn out. Not only for Green Brick has been a beneficiary of that, but tons of home builders as well. We also had talked about this, one of the last couple of bull sessions of 2023. We brought up a little bit about this. So for those who are new to it, I'm gonna bring you into this with a little bit of industry information as well, and assure you that while I certainly don't promise a double, it is not too late to think about investing in the home builders, which is traditionally and will be in the future a cyclical industry that wouldn't normally follow better investing style or rules. It's not too late to do so at this point. Next slide. So just an introduction, and there's one point you'll have to remember going through this, but Green Brick Partners was started by David Einhorn's Greenlight Capital. They came in with a 49% ownership on day one, and Jim Brickman, who was an industry veteran. In my phrase there at the bottom, it's a bunch of hedge fund guys running a home builder. They run this company, and you hate to try and make a grandiose comparison, but kind of like how Berkshire Hathaway buys companies, in the sense that they have a very small corporate group or core group, and looks to give their operating companies, which they can start up fresh or buy, a lot of leeway to run as their environments demand. The point to remember is that they did a reverse acquisition of a company, basically bought out a company's ticker and tax loss carry forwards. The company was a biofuels company out of Denver on October 28th, 2014. So that's still relevant. When you look at your SSGs to start with now, please cross out 2013 and 2014. They really don't matter here. Next slide. So Green Brick started in Dallas-Fort Worth. It's still their largest market. Their second largest market is Atlanta. They also have operations on the Treasure Coast of Florida in Port St. Lucie, in Colorado Springs, and just getting into Denver, Colorado, and they've just started actually selling their first houses now in Austin, Texas. You can see the variety of brands they have here. Now, the Trophy brand, the first one under Texas, is probably the one exception in this list, that they do have Trophy properties among multiple markets, and Trophy is their entry-level home builder. So they have common there, but again, what you won't see versus another home builder is that they look to partner with established, known brands in the various markets. They are not afraid to go in even as minority partners. Again, 49% sort of deal. The operations in Colorado Springs, I think they're at about an 80% partnership, and Treasure Coast is 50-50. So they're definitely looking for private home builders to come in to provide them capital to grow faster, and discipline, the discipline of hedge funds, and build the homes that they know for their market, rather than come in, relabel them under the Green Brick brands, and then do business their way consistently across the country. It's a big differentiator that attracted me when I first looked at them in 2021. Next slide. So just to put into perspective, when we talk, I'm going to throw a few slides about the performance of Green Brick. This is a slide from Statistica based on 2022 revenue, the largest home builders in the country, and I've zoomed it out a little bit on the right-hand side. You can see Green Brick isn't there. The smallest one on this list is Dreamfinders Homes. There you go, Ken, on the list. A number of other ones Ken and others have handled. Green Brick is a little over half that size, so just under $2 billion revenue. And we're going to see just how they play with those big boys in the next few slides. Next slide, please. So the next few slides are from Green Brick's last quarterly earnings presentation. They've done these slides, these same metrics, since they started, really, for a very long time. So if you're new to the company, you may find it interesting to go back to these same slides and see how they've progressed. But at this point, it's all pretty much. So I just want to make sure that they're not cherry picking just the metrics they do best in. I think that this management has given an honest view of who they think are the best in the business, and looking to put themselves up against it. So in 2020, 2021, you'd often see Green Brick actually just after LGIH. They were probably their nearest compatible competitor, or close competitor for a long time. But here we can see that a tiny little company has the best growth. So you think about the types of things that an economy of scale can get you, purchasing leverage, efficiency leverages. They're sort of pushing against the grain there. Huge gross margin, and this is definitely records for Green Brick, but it's been on a steady increase for the last 4 years. Next slide. There's words on the left. I'm not really going to focus on them. I want to bring over to the graphs on the right. Net sales orders. So 2022 is an interesting year. Green Brick themselves actually had sales drop by 30%, but still set record revenues because, of course, as everybody knows, homes prices have gone up. So the industry was kind of at a point of wondering how much to build and whether they were shrinking for a while or going to keep growing. And you can see there is kind of a dichotomy there. There are a number of builders, including some of the biggest builders, that had been, and whether they were playing it very conservatively and not selling a lot or just not realizing a lot of sales, have seen sales drop further. Then there are other ones on the left side that have actually re-accelerated or gone back into a growth mode, even as the industry overall is continuing to shrink because of high interest rates. Not a surprise. The bottom right, and I really want to point this out, they've done all this, they've grown all this way without over leveraging. In fact, they have one of the lowest debt to capital ratios in the industry. Now this is a smaller group of peers, but you can see the peer average there. Just take a drink, sorry. So Green Brick actually in 2022 bought back 10% of their outstanding shares, which is an excellent buy for them before the double. Sorry, just start. They did that without increasing their leverage. And in fact, this summer, there was an analyst question about whether they were going to do another major buyback as well, given that their stock is appreciated. They said no, they weren't, and it had nothing to do with the stock. They were battening down the hatches to make sure that they could survive a high interest rate environment. So they're a $2 billion market cap company with over $200 million in cash. Now they do have net debt, but their revolver, their line of credit of $650 million actually sits with a balance of 0. So they wanted to be in a very strong financial position going into the uncertainty of what 2023 and 2024 would bring, looking for potential acquisitions. Again, this is an acquisitive company. They've done 3 so far in their short history. They foresee that there is signs of stress in some of their competitors, which might give them opportunity either for, again, partnerships for a private company, won't be shown in these peers, possible acquisitions, even though they're bigger revenue companies, the market caps may be compatible. They have a lot of credit to do, or some, let's say, pieces. There may be developments or land that other companies walk away from that might be something Green Brick wants to pounce on. That's another point of leverage. As a company that small, Green Brick does have an in-house finance arm, so they can actually write you the mortgage in case that's hard to do, and therefore have the flexibility to do things like buy down your rates as an inducement to keep you in a contract. They have one of the lowest contract cancellation rates going on. That's another slide didn't cover. And they also do their own land development, another thing that small companies don't do. Rather than either go in and buy developed lots somewhere else, sort of compete with a bunch of other builders. If you see very large developments have several builders going on at the same time, they are vertically integrated and work soup to nuts to capture the whole value of undeveloped land to built houses. All right, next slide. So I'm going to go into the industry, but I just want to show just the briefest glimpse of section 1. We are, even in a cyclical industry, a highly growing company, up straight and parallel. A few bumps on the earnings side in 2017. You have the tax changes, things going on there. Like I said, disregard 2013 and 2014. That's data from the prior company and the acquisition of it. But we're going to see that this was not smooth sailing for the housing industry these last years. And an excellent, even in a cyclical industry, a difficult industry, to show that kind of characteristic in a company that is not moving their market, is playing their niche, but is subject to a lot of external factors, is a strong sign of good management. Next slide. So now we're going to zoom out and talk about housing market trends, and maybe bust a few things that you've seen in some media, and maybe confirm a few things. And when we say long-term, we mean our long-term. This is a chart from Fred, from the St. Louis Fed's long-term data set. This is from 1960, or technically 1959, but 1960 to 2023, new housing units started. This is total units, not just single family. So apartment houses, multifamily homes, single family homes. And the data that comes from the National Association of Realtors is that the long-term average of this trend from 1960 to 2000 is 1.5 million units, housing units. It could be houses or apartments per year. Now that's a little strange if you think about it. The US today has 75% more people than they did in 1960. And this data set is not a per capita set or an adjusted set. It's raw numbers. So it's kind of strange that it does oscillate around that kind of an average number. It isn't increasing. Of course, the US, the population growth has slowed. You know, once you have a house, you don't necessarily need a different house. You might swap houses. That's +1, -1. But while the population growth has slowed, actually the household formation trend is somewhat stronger than that. There are more households of singles that are single for longer or forever than there were before too. So with all the variables plus and minus, this set had been largely not static, but let's say stable until the 2000s. Let's go to the next slide and zoom in on that. Okay, so this is a 20-year view, and isn't it scary to think about that our first views of what became the great financial crisis is now 15 to 20 years in the rearview mirror. But we got a point from the 2000s where we have an overbuilt set, right? And for anyone who remembers that or has read about that, right, you have house flippers and ninja loans with no verification of income. What was, let's say, crazy and got to be too much and was a big part of the recession, of why we had a crash. The interesting point is that was so bad for the housing industry. In fact, they lost over 300,000 skilled laborers, left the industry permanently, right? And so this is not 300,000 fast food workers leaving, where you just need to find people and bring them back up. These are carpenters, electricians, plumbers, people with not only skilled labor, but certifications, registrations to come back on. Took a long time to get back. You might say some people wondered if it would be permanent, but we essentially have underbuilt from that stable level for a full decade. And in fact, even in the more recent times where we think that things are crazy, yeah, go ahead and hit that. You know, in 2021, we only just got above that level. So we think 2021 was crazy and things were around, and maybe it was like 2006 all over again. We're only a little bit above average. And of course, as the Fed began to raise their rates, we actually went back below average. We're back to digging the hole instead of filling that hole in. In 2021, the quote below, the National Association, well, it was actually Rosen Consulting Group, but a study commissioned by the National Association of Realtors estimated that we had a gap, that overall underbuilt gap of 6.8 million units that we needed to rebuild in order to reach what we all might think is equilibrium in the housing market. Next slide. So the other thing that's uneven recently or in the news is the fact that people are locked into their low mortgage rates, right? If only mortgage rates would drop a little bit, people are gonna, there's a pent up demand to hurry up and move away, and things will ease quite a bit. But this is a 10-year trend. This is from Trading Economics, and it's a little bit less flexible tool, so it doesn't go all the way back to the financial crisis. Give me another click mark. But one thing to point out is it's not just a pandemic issue. So this is seasonal data. That's why you see the regular ups and downs. The fourth quarter, which we just finished, is traditionally slow in this industry. There aren't a lot of people buying, so there aren't a lot of people selling. But this is the total housing inventory, the existing homes for sale. We go up and down every year through the 4 quarters. And if you look at the peak in 2014 versus the peak in 2019, that's about a 30% drop in the number of houses available or number of houses listed. The peak time is the spring selling season. That's actually the same amount of drop on the last point that the building went down. So it's not a coincidence that if you're not building enough, then sort of you're absorbing whatever people might list a house for. Someone dies, something's redundant, something like that. There are natural listings as opposed to people moving back and forth. This has actually also been a trend that's been building for a decade. Yes, exacerbated by high interest rates, but not created because of them. These are two somewhat related, but trends that add on to each other to say there's a scarcity of building, and this is nationwide. It's definitely more acute in certain locations. We'll talk more about that later. Next slide. So the future. So that's up till now. What are some of the trends we're looking forward to, or why we might invest? The first thing, and this is a slide Green Brick has again included in every year that they've gone forward, but the fact that the population of 35 to 44-year-olds, which you can research, but take for their point right now, are the most active home buyer, is on the upswing. And again, think about that. That's not necessarily a coincidence. It's probably additive to the trend. It was on the downswing as building was going up prior to the global financial crisis. This chart was actually on the downswing, bottoming out in 2012, 2013, and it goes up just as home building starts to pick up from its bottom as well. As you can see, this demographic tailwind has another decade to go. Not as big as the late 90s, but at the point where we have no slack in the system, any more demand is going to speak volumes or be very impactful. Next slide. So this is where we get back to location, location, location. On the left is a UN projection of the largest US cities. Was 1950, 2010, you see the projection for 2030. Again, on the right is a very interesting tool, again, from the National Association of Realtors. It just looks back at prior year data, but they call it the housing shortage tracker. So what their data says is that to maintain your housing level or your housing market at a certain level, you should build a new house for every 2 new jobs created in a city. I think that's a conservative estimate. It's basically assuming that every household is a 2-income household. And for whatever degree you have singles, it's even more impactful than that. I've added to that chart some call outs to the markets that Green Brick operates in. So you can see Dallas, Fort Worth, their biggest market, Atlanta, Austin, Colorado Springs, and Port St. Lucie, the Treasure Coast part. You'll see that those are generally, I'll call it pink, light red zones. Their need for more permits, not the high housing shortage. And you say, well, wait a minute, wouldn't they go to the high housing shortage ones? Well, that can get fraught with. Of course, New York City and LA and Hawaii are there, but they're not there for lack of builders to go through. They're there because there are other problems, lack of land, regulations, permits needed to go through that slow things down. So I think it's telling that the typical Green Brick market is definite need for permits, but with space, with cooperative local governments, with the ability to accelerate or grow quickly, and see this as a need to be addressed, not necessarily a problem for someone else to solve. Now, the one, if you have eagle eyes or zoomed in, the one exception to that looks like it's Port St. Lucie, which is blue, sufficient supply. It's a blue dot on a big red eye of Miami, which certainly does have housing issues as well, and we'll address that on the next slide. One thing, unless you think that Port St. Lucie really is an exception to Green Bricks, I would say that they're just looking forward in time or looking ahead. This is an announcement from October that Brightline, the high-speed rail that goes from Miami to Orlando, is looking to add a station in, you can see St. Lucie County or Martin County, somewhere in the Treasure Coast, which would essentially allow Port St. Lucie or the Treasure Coast area to become a commuting city into Miami. Have a high, not just a commuting line, but a high-speed commuting line straight into downtown Miami. So Green Brick's current offerings in Port St. Lucie tend to be on the higher end. They just opened up a small development of $1 million plus homes on the waterfront. But operating in that city and seeing a major piece of infrastructure like this comes in gives them the opportunity to then go and apply, whether it's Trophy or another one of their labels can bring in and adjust to the demand that comes to them. So Port St. Lucie, I think, is a bit of a hidden gem on the side that, if the Brightline plans move forward, could really shine for them. Next slide. All right, so now let's go to the SSG. There's not a lot of help with this. Again, we crossed out 13 and 14. That was the prior company, nothing to do with them. We can see that nice up straight and parallel, at least to 2022. I have added in this SSG the shares outstanding, just to point out, make sure to remind myself that they did a large stock buyback actually in 2022. And so that has impacted things. Now you will see 2023 is a little bit lower than 2022, very moderately lower. They are selling more units, but they're selling at a slightly lower price. They're essentially giving concessions in order to keep people in the contracts. That's still a very high level, but it will be at a plateau at this point. They have amazing historical growth. The sales estimate is just 4.4% growth for 2 years. When we get to a couple slides down, I'll say there isn't a lot of guidance from our typical resources to say something better than that. So it's a trick to go through here just to think about what the forecast for 5 years would be for a company that's proven to grow that long, but is entering, let's say, the next phase or the next tricky market. Before I get into the projections, just to do section 2, evaluate management, all green, all good. Look at amazing returns on equity in the 20s for a capital intensive business. And again, debt to capital. The debt to capital looks a little higher here. The chart that Green Brick uses is net debt. So they take out their cash, but still in an industry, again, that you have to relax your better investing instincts a bit if you want to get into it, still well within the 33% we would otherwise want. And pre-tax profit on sales has always been strong and has only been stronger in these difficult times. Now, I took a 10% forecast growth that is in revenue. That is the better investing sentiment that doesn't come from another amount that is a lot slower growth than what they've had. It is tough to tell when you think about the 2-year sales estimates. Remember, this is an acquisitive company. It's also still a small company. It's about $2 billion in revenue. So they could easily grow that much faster with some kind of moderate or significant acquisition as they could growing organically, which they are doing. They just, like I said, they just entered the Austin market, which is a huge market, tops a lot of growth lists. So I think 4.4%, I believe that's also, at least on the value line sheet, they said there was only 2 analysts as well. Probably conservative when you have to publish a number, but I think that's certainly less than what management is shooting for. All right, next slide. To do the earnings per share forecast, I did use the preferred procedure, so you can start with a 10% growth rate. I look at the pre-tax profit margin and taxes as roughly in line, more leaning toward the recent years. The big thing I want to point out here is the share count. So the share count shows 45.8, and you wonder where there might go. Again, they have enough cash on hand to buy off another 5% of shares this year without taking on any debt. So you could simply grow you could rinse and repeat if you didn't grow that much, or even if you want to just take on a little bit more debt. I believe there will be a combination of that. To point out a tool point here, what I have on the right, the share count that is used when showing the preferred procedure is a accounting term called the weighted average shares. And so this might give you the impression that shares went down from 51 to 48 in 2022 and further went down to 45 in 2023, which might make you think, wait a minute, they were buying shares back when it was 50 as opposed to when it was 25. So I've pulled out this comment, which is from the balance sheet on December of 2022 to show that, no, indeed, on December 22, their share count was 46 million. And in 2021 was 50 million. So they're 50.8. They did buy back 5 million shares in 2022. The large part, the majority of the 2023 changes are essentially the accounting catching up with the work that was done. So it was all done when the share price was much cheaper. It's not that something that they're still going on now. Talk about our advisors. So again, on the upper left, Value Line is not too much of a help. It is in the Value Line Extended Edition, and they're not projecting anything other than earnings per share. I did include that point on the SSG in the prior slide, but it wasn't that useful. On the bottom left, Morningstar does say it's trading at a 30% discount, but that's just the quantitative rating, so that's an algorithm's idea. Nice that it's 4 rather than 2 stars, but doesn't really give you any information to work on. Of course, we have the full screen of Manifest Investing coming back to the screen where I came from. If you can give me a click mark. Okay, so 2 things to see. They have Manifest as a very high sales growth forecast of 15%. That's still only half of what they've done in the past, but a company this young will slow down, right? You can't compound the same amount after you've started out. That's a high rate of growth compared to my judgment. Where we kind of have the flip side is there are no share buybacks predicted. This essentially flat projected shares outstanding compared to before. And those are 2 things you can play with, right? Maybe they don't buy any shares back because business is so good, or the opportunities for purchases are so good. That's fine. I'm okay with both of these mixes, is my point. And however you think that the opportunities will go through, it's those 2 things playing together. One more click. The other thing to point out, and we'll see as we go to section 3, this is where usually we talk about the average PE, and that's pretty dead on. This is actually close to the high PE. Again, that can be tricky with a company in a cyclical industry. It's perfectly valid, but we can see where that lines up versus the SSG in terms of the PAR or the compound annual return. But that's fine so far. It looks to be in line, even though it's a little bit different. So sections 3 and 4 of my SSG, I did take out the high PE in 2022, right? Again, it's in a cyclical industry. It's not unusual to have your lowest high PE happen when you're getting your highest revenue. But I think that was unfairly punishing the company. And in fact, that's one of the reasons why the company took such a bold step to buy back shares. And then I took out, of course, the March 2020 low. It was almost that low in 2022. I didn't want to take both of them out, but I'll take 1 strike out for that. Evaluating risk reward, section 4, I use the high price times the high earnings per share. Again, can be tricky with a cyclical company because you usually don't get the high PE, but the high PE is plus or minus 10 just about every year there other than 2022. So I was comfortable with that. A high of 123, forecast low PE by low price is 29.3. That's within spitting distance of the 52-week low of 23. So I just called it on there. It is a 3.2 to 1 upside downside ratio. It is in the buy up to 53. We're close to that, not too much more. 1 more click and we'll see section 5. So section 5 gives us a compound annual return of 19% compared to Manifest 19.2. The average PE, and again, speaking more linearly of the average PE, might be 12%. Still not bad as a downside for a company that has so far navigated the trickiest real estate environment since the great financial crisis with aplomb. That is Green Brick Partners.
Good stuff. Good stuff, Matt. Thank you. All right, Ken.
Let's look again at Technoglass.
Go ahead, sir.
I've presented Technoglass. Are you hearing me, Mark?
Yep, you're fine.
Oh, okay. I presented Technoglass about 6 months ago. It's a leading architectural glass manufacturer. Almost all the glass you see in this picture as the background is manufactured by Technoglass, and we'll talk about that glass just a little bit as we get into the presentation. Next slide, please. I was very interested in the November 2023 Forbes list of the best small cap companies. This is not the best small companies necessarily, but the lists do kind of track together with each other when we put together lists of small companies. And number one on the list from November 2023 was Technoglass. Quite an interesting article goes with the calling of Technoglass as number one. Forbes gives a nice write-up to the company, and I would urge you to get a hold of the magazine. It's not the easiest thing in the world to find. Here's a clue. If you go to the Technoglass website, you will find an investor presentation. They are quite proud of this number one ranking on Forbes, and they've presented a link directly to the article that Forbes wrote about Technoglass. That's perhaps the easiest way to find the article and to read it. I'm not going to print it out. It takes too much time for me, but you can spend a minute or two if you're really interested in this company. Next slide. Most of the revenues for this company come from the United States and Canada. 96% of the revenues are United States. 4% come from Latin America and other places. The revenues are 60-40 split between single-family residential, SF, single-family residential, and multifamily and commercial buildings where they're providing the glass. They provide glass under a number of different brands. If you're in the building trades, you might recognize some of the brands that are listed right here. Next slide. It's more important for people to understand that Technoglass provides different kinds of glass. It's just not all clear window glass. And you can see off to the left here some of the different types of glass that it in fact provides for its customers and the features that go along with the types of glass. Especially important in a lot of the southern states where Technoglass sells a lot of its product is the hurricane resistance that they can build into very much of the glass that they sell. You can see where the revenues are coming from and the types of glass that are going into multifamily and commercial markets. And you can also see the types of glass going into the single family residential markets. Next slide. They began with most of their business in the Florida area, specifically Miami. They've developed a very, very large presence now in Texas. And by this point, they do have an office open in Texas right now, an operational showroom. Where the red dots are, you can see that they have showrooms in South Carolina and in New York, and they'll be opening showrooms in California and Arizona. They plan to make a penetration, quite a big penetration in the eastern part of the company, but there's still a lot of geographic expansion that can occur for this company, even in the states where they're beginning a presence right now. Next slide. They just entered the vinyl window market. For years, they have been in the wood, aluminum, fiberglass window market, but they are now entering the vinyl window market, and that's going to increase their addressable market significantly. It'll more than double the addressable market. And by adding all the different types of windows and by adding all the different types of glasses, their addressable market keeps growing at a rate faster than the sales for this particular company. So this idea of building buildings with huge glass walls and with huge glass windows is really playing to the strengths of Technoglass. They started with their headquarters in Colombia and their major manufacturing unit in Colombia. They recently moved their headquarters now to Miami, Florida, but their major manufacturing site is still in Colombia. Next slide, please. You can see what building in Colombia, what kind of advantage it gives them. This is a fully vertically integrated operation, which means the company begins with raw material at the left end of the chart, at the very top there with the arrowheads, and it moves through and creates all of the different steps in the glass process in-house, and ends up with selling and distributing and installing all of the products that it makes. So it's completely integrated, and it's doing all of the manufacturing in a 5.6 million, that's million square foot operation in Barranquilla, Colombia. It's about a $1 billion facility, and it employs 9,000 approximately people. You can see off to the right the differences in labor costs by manufacturing in Colombia versus the US, the differences in transportation costs to get the goods to market if you're moving from Colombia rather than a single location in the US, and most importantly, the differences in energy as you're going from Colombia versus what the US energy costs are. This is a very well thought out strategy to keep costs low and to keep profits high. Next slide. There's where Barranquilla is located. It's right at the Gulf side, the Caribbean side of Colombia. It's on the water. You can see the water in that picture right there. And it's a huge facility where they can ship all over the world. What's very important is that ships that are coming to Colombia are usually very full of goods, but ships leaving Colombia are starved for exports to take to other places in the world. So Technoglass can bargain very low shipping rates moving from Colombia to other places in the world. And remember, they're getting their supply of raw materials right from Colombia itself. Next slide. The name of the place where they're building, where they're getting their supplies is a little, the center of it is a town called Saint-Gobain. And you can see the vertical process going from suppliers all the way to raw materials, and then all the way to sales, distribution, and installation. They do it all for the glass that they manufacture. Next slide. Since 2017, sales for this company grew about 15%, and earnings grew about 80% annualized. Since 2020, sales have grown at 38%, with earnings growing at 151%. It's still a very small company. In 2022, it had $717 million in sales. So that's a pretty small company when you compare it to the companies we've been looking at tonight. I'm forecasting sales growth of 18%, earnings growth of 16.2% coming from the preferred procedure. You can see the evaluate management numbers are all basically green on trend, and they're all basically looking like the kind of numbers we like to see for a manufacturing concern. I especially like the fact that the company has worked very, very diligently to move its debt from in the 80s down to 32.7%. Its debt to capital. It's still it's moved below its 5-year average. The 5-year average is more than I'd like to see, but the most current debt to capital number is certainly encouraging, and the balance sheet is beginning to reflect the fact that they are getting their leverage well under control. Next slide. You can see that I struck 2018 as being anomalous to the rest of the high and low PE values. I'm getting an average of about 16.7 on the high side. I used 17 on my SSG, getting an average of 6.2 on the low side, with the last 3 most current years being under 5. So I'm using 5 at the low side. Current PE of just under 11, 4-year average, because I've struck a year, 4-year average of about 11.5. So it's a little bit undervalued, but not by very much. And it has a lot of room to push itself and to expand its PE if the profitability stays at the level it's been at. Next slide, please. My SSG ends up showing a buy with a par value of 17.2% annualized. That compares quite consistently with manifest par value of 18.8%. I'm very confident that my analysis is in the right ballpark. I like also the top potential return. This number of 17.2 is coming with a PE of about 10.5 or 11. If that PE rises into the neighborhood of 15 or 16, the total return has the possibility to rise into the mid 20% area. And that's very encouraging for a company like this. I think that I'm getting on the ride at the right time, with the potential to ride this company to a better PE, a higher company as it grows from small to mid-size. Next slide. When I first presented Technoglass last August, it was trading at $33.86 a share. Yesterday, before we started trading, January 1st, the company was trading at $46.30. That's a gain of about $12.50, and I still think there's money to be made. I urge you, if you're interested in the company, first of all, to look at the new investor presentation. There's a brand new investor presentation on the Teleglass website. And then if you have access to Forbes, and I've told you you can get access right through that investor presentation, read the article that names it as the best small company for 2024 in the November issue of Forbes magazine. I'm asking us to put another $1,000 into Technoglass, TGLS.
Well, thanks, Ken. And it certainly was our best small company for 2023 in the exercise that we do. So we're grateful for it. Pretty sure it's in this year's list also.
It is.
Okay. All right. You guys have stuck me with the lightning round again, so I'm just going to go through some things pretty quickly here. Healthcare has been decimated in the last couple of quarters, and I just thought I would hold my finger up in the air, run a quick screen on healthcare only. So we're looking at just the healthcare sector and companies that have attractive quality and return. There's a number of decent studies in here, including fairly recent additions to the roundtable portfolio at Globus, InMode. There's almost all those companies are worthy of a study. I think we added Shockwave last month. And this is a really good study that Ken pointed out mid last year. It's a company that makes the injection devices for many pharmaceutical companies. And that's worth a closer look. Ticker symbol STVN. I do actually own some of that one. But going down this list, a good friend from our best small company list showed up here, and I've decided to take a closer look at that one also. Here's a look at the top, what we refer to as the 100 Club. These are the top companies that have the best projected return and quality in the manifest universe. And you can see that a number of companies that we have mentioned, by the way, Kevin's Chevron is just barely off this list right now. So all 4 companies are basically here. And you can, again, it's just a nice place to go shopping, looking for opportunity, top to bottom. And SMLR being here is a good thing. Here is our best small company list for this year. Ken will say that I'm jinxing it by mentioning it, but since Halloween, we are up over 30%. And Technoglass it was our number 1 company performance-wise last year, and SMLR is also in the list this year. Again, a fairly decent shopping list. These companies were so depressed and languishing back in that time frame that I think you can kind of look beyond what has happened so quickly, much as Matt has done with Green Brick and Ken has mentioned with Technoglass. There's probably still room in these because they were beat up so badly in the first place. But here's a look at SMLR. The nutshell is that none of us like heart attacks or strokes. And this company is in the early detection business, very cost-effective, quick, and good efficacy for detecting peripheral artery disease. And it's just simply clogging up of arteries. And they basically have a fairly quick device for figuring this out. If you go in and actually have it done in the hospital or clinic, they put the cuffs on you, just like blood pressure cuffs, and they have to do some gymnastics to do the type of testing for this condition. In this case, this goes back to that oxygen sensor company that we had years ago. Again, most of us are familiar with these O2 sensors, thanks to the COVID time frame and the pandemic. You just simply clip them on, get your readings, and go. And it's quick and very cost effective. The other thing I like to see from this company is they are attempting to take some of their talent when it comes to this type of stuff into the diabetics insulin dosing area for optimization type strategies. And I do like the fact that they are working for early Alzheimer detection also. Quick and dirty, here's a look at the company. Brief operating history. It's actually coming into its own. I think we can argue basically up, straight, and parallel for a company of this size. Again, they are under 100 million in sales. We're talking 12 to 13% for a growth rate, a projected net margin that's been pretty steady in the mid 20s, a PE ratio in the mid 20s. So again, there's nothing certainly on fire about any of that, netting us a projected return of 18%. That compares very favorably to our cash flow driven projected return on value of 20%. And again, for a company this young and kind of compelling, intriguing, pretty good quality rating, and again, a company that I think can prosper in the roundtable tracking portfolio. So it's in the best small companies for last year and this year, and I'm just saying we need to add it to the roundtable tracking portfolio. And just a thought from Hugh McManus, and I think we're ready for our poll, Ken.
Okay, give me just a second here, if you would, Mark. And let's launch that poll. Doesn't take any thing to vote. Use your mouse, use your finger if you have a touch screen. And we'd like to know which one of the 4 companies you'd like to add a second $1,000 too. If you don't like any of them, we always have the none of the above where you can vote right there.
Now, I'm sure some of you want to write in Portillo's, but we'll bring that back in the future, I'm sure.
We really like to see about 85, 90% of you voting. We're up to 75%. Come on, help us out. It doesn't cost anything, and it's kind of a fun exercise to see where our audience is coming from. Our audience has been quite successful in the last 12 months in picking the best stock by that chart that Mark showed us earlier. That moved us right over 90% voting. So I'm going to count to 10 in my head here. And when I get there, I'm going to close the polls. If you haven't voted yet, you got about 3 seconds. And I'm closing the polls, and I will share the results. And, well, Mark, they liked the 2 small ones. Well, we had 3 small ones, actually, didn't we? Looks like we'll add another $1,000 in Technoglass, 30% SMLR, 19% Green Brick, and 10% in Chevron. We have 1% that didn't like any of them. Okay.
Not bad.
They wanted Portillo's. They wanted Portillo's.
They wanted Portillo's. Okay.
Who doesn't? Who doesn't?
And I have to compliment.
Well, I think if they go to Bink, they'll be able to eat a lot of it with you and Ken sponsoring them.
Don't make these promises, okay, Kevin? Matt, you were saying something. Go on.
I just have to compliment you letting Green Brick be green. Thanks for the color coordination.
I think that's completely random. So.
No. Pretending it was planned.
Okay. All right.
All right. For our announcements, again, as some of you have asked, we do archive these presentations on YouTube. If you simply go to YouTube and search for either Manifest Investing or simply Investing Roundtable, they do show up. And we do put all of the bull sessions and any of the special programs. For example, that Best Small Company program where we selected both Technoglass and SMLR is right there. And just an opportunity to check in on some other stuff. Kevin, would you like to share your upcoming program?
Yes,
An invitation.
It is. This next Monday on the 8th, you can go to the DC chapter. And this is, if you get these slides, there's a hyperlink to this. It's from it's at 7 p.m. We're looking at those 4 stocks. We're allowed to look at a bank because Ken doesn't allow us to look at any banks. He keeps all of them here at the round table for himself. So I'm able to finally present a bank. I've never been able to do one here at the round table. So I'm going to do East West Bank Corporation next week, along with the stock to study, which is Gentech, and the undervalued feature, which is Ares Capital Corporation. So come and join us. That's something that's done by both the DC regional chapter and the Maryland chapter. And it's free and will also be up on YouTube afterwards, but you can find us on the DC chapter. And in fact, several of our directors are in the audience tonight.
Again, folks, if you want copies of the slides, send an email to Mark R at manifestinvesting.com. That's MARKR at manifestinvesting.com. He's not going to pull your name from the question box here. So if you want those slides, you need to send him an email. Put it on right now while you're thinking of it. He'll get it out to you in the next day or so. With that, we do have some upcoming events with our Getting Started program tomorrow and Thursday. The titles of the 3 classes are The Grand Experiment, that's at 6 o'clock tomorrow. Making Reasonable Forecasts, that's at 8 o'clock tomorrow. And then Finding Great Stocks to Study, that's at 8 o'clock on Thursday. Our January roundtable will be the normal last Tuesday of the month. So the last Tuesday in January is the roundtable. And we're telling you to save the dates right now. These are tentative dates, but we're going to be doing a Mid-Michigan Successful Investing Conference, pre-4 or 5 classes on April 10th and 11th. So save the date right now, and we'll have many more details for you to follow. I know this has been a long one tonight, but we appreciate your patience. We appreciate you coming, and thank you so much to Kevin and to Matt and Mark. A giant thank you to you for all the things you do for the Mid-Michigan chapter and for the investing public
And
that comes to
I
our
think
events.
I think we can go ahead and send everybody off with this Irish observation of New Year's Eve in Ireland. Open the back door, let 2023, give it a warm hug and let it go. Open your front door and let's get to work on 2024.
I like that, Mark. All right.
Good stuff. All right. Thanks, guys.
Good night,
Good night,
everybody.
all.
Thanks for coming.
Hey, everyone.